Ladies and gentlemen, in the last 72 hours, something happened that Wall Street didn't see coming, that most mainstream media buried on page 7, and that could fundamentally reshape how money flows across the planet for the next decade. While you were scrolling through your feed, while analysts were debating inflation data, while everyone was focused on the Federal Reserve's next move, a single policy decision involving a frozen island most people can't find on a map just sent shockwaves through currency markets, commodity futures, defense stocks, and the entire geopolitical chessboard. I'm talking about the Greenland Tariff announcement, and if you think this is just another political headline that won't affect your portfolio, your retirement account, or the cash sitting in your bank, you need to understand something right now. The smart money has already moved. Institutional traders have already repositioned. And while retail investors are still trying to figure out what Greenland even has to do with their Apple shares or their crypto holdings, billions of dollars are quietly shifting from one side of the market to the other. So the question burning through trading desks in New York, London, Hong Kong, and Frankfurt isn't whether this matters. The question is whether you're positioned on the right side of what's coming next, or whether you're about to watch your wealth erode while someone else captures the opportunity you didn't see. Stay with me, because what I'm about to reveal will change how you see the global financial system forever. Let's start with what actually happened, because the surface story and the real story are two completely different things. On the surface, this appears to be a straightforward tariff implementation, a trade policy adjustment involving Greenland's rare earth mineral exports, critical materials that power everything from smartphones to electric vehicles to military defense systems. The official narrative talks about national security, about supply chain resilience, about reducing dependency on certain geopolitical rivals. But here's what they're not telling you. Greenland sits on an estimated $1.5 trillion worth of untapped resources, rare earth elements that are absolutely essential for the technology that runs modern civilization. We're talking about neodymium for permanent magnets, dysprosium for wind turbines, europium for LED screens, and dozens of other elements that you've never heard of, but that you literally cannot live without in today's world. For decades, one country has dominated the global supply of these materials, controlling roughly 70% of production and over 90% of processing capacity. That country has weaponized this monopoly before, and the geopolitical implications are staggering. Now, when this tariff was announced, framing it as a protective measure for strategic resources, the immediate reaction was confusion. Traders didn't know how to price it. Analysts scrambled to understand the second and third order effects. But within hours, certain sectors started moving in ways that revealed exactly what the big players understood before everyone else. Defense contractors surged. Companies involved in rare earth processing jumped double digits. Currency pairs that most retail investors never watch started experiencing unusual volatility. The yuan weakened against the dollar in a pattern that suggested massive institutional repositioning. Gold ticked up, then pulled back, then surged again as safe haven flows competed with industrial demand signals. This wasn't random noise. This was the footprint of smart money seeing an inflection point and acting decisively while the crowd was still reading headlines. Think about what this tariff actually represents from a financial architecture perspective. For the first time in generations, we're watching a potential fracture in the resource supply chain that underpins trillions of dollars in market capitalization across technology, automotive, renewable energy, and defense sectors. Every major corporation that relies on these materials now faces a strategic decision. Do they lock in supply contracts at higher prices? Do they diversify their supplier base, accepting the friction costs of building new relationships and logistics networks? Do they invest in domestic processing capabilities, which would require massive capital expenditure and years of development? Each of these decisions has profound implications for profit margins, for competitive positioning, for stock valuations. And here's the critical insight that separates sophisticated investors from everyone else. The companies that move first, that secure alternative supply chains before the scramble intensifies, those companies will command a premium. The companies that wait, that hope this blows over, that operate with business as usual assumptions, those companies will face compression, delays, cost overruns, and ultimately multiple contraction as the market reprices their risk profile. Now let's zoom out and look at what's happening in the broader market structure, because this Greenland situation isn't occurring in a vacuum. We're already in an environment where volatility has been suppressed for months through central bank policy, through systematic option selling strategies, through algorithmic trading that dampens intraday swings. When you suppress volatility artificially, you create a coiled spring. You build up potential energy that eventually has to release. And what we're seeing in the past week is the early tremors of that release mechanism. The VIX, the market's fear gauge, spiked 17% in a single session following the tariff announcement before settling into an elevated range. That's not panic, that's recalibration. That's the market acknowledging that a new variable just entered the equation, one that doesn't fit neatly into the models that have worked for the past 2 years. Commodity markets are telling an even more interesting story. Lithium prices, which had been in a brutal bear market for 18 months, suddenly found a floor and bounced hard. Cobalt futures started climbing. Uranium, which powers the nuclear plants that many countries are now prioritizing for energy independence, hit multi-year highs. What you're witnessing is the market pricing in scarcity, pricing in geopolitical fragmentation, pricing in the end of the era where you could assume global supply chains would remain stable and optimized purely for cost efficiency. The entire framework that governed resource allocation for the past 3 decades, this idea of frictionless globalization, of just-in-time inventory, of sourcing materials wherever they're cheapest, regardless of political considerations, that framework is dying. And when a framework dies, the assets that thrived under that framework face revaluation, while new winners emerge that are positioned for the new paradigm. Let's talk about currency flows, because this is where things get genuinely fascinating for anyone who understands how global capital actually moves. When a tariff like this gets implemented, it's not just about the direct trade relationship, it's about how reserve currencies function, how trade settlements occur, how nations choose to hold their foreign exchange reserves. If Greenland's resources become a strategic asset in a multipolar world where supply chain security matters more than pure price optimization, then countries need to think differently about their currency exposure. Do you hold more dollars if the dollar-based system is facilitating access to critical resources? Do you diversify into other currencies if you're being shut out of certain supply chains? Do you accelerate the development of alternative payment systems that bypass traditional channels entirely? These aren't theoretical questions. Central banks are actively gaming these scenarios out right now. And when central banks move, when they shift even 1 or 2% of their trillion-dollar reserve portfolios, that creates tidal waves in foreign exchange markets that can persist for years. The bond market reaction has been equally revealing. Initially, you saw a flight to safety, treasuries rallying as uncertainty spiked. But then, something curious happened. Long-dated treasury yields started rising even as short-term yields fell, steepening the yield curve in a way that suggests the market is pricing in either higher long-term inflation from supply chain disruptions or a reassessment of fiscal sustainability, as governments potentially need to spend massive sums on strategic resource security. Either interpretation is significant. If inflation expectations are rising because critical input costs are going up, that puts central banks in an impossible position. They can't easily cut rates to support growth if the growth slowdown is accompanied by cost-push inflation. And if fiscal concerns are emerging because nations are about to engage in a resource security arms race, spending hundreds of billions on domestic production capacities, on strategic reserves, on military protection of supply routes, then the entire foundation of bond market stability comes into question. Now, here's where retail investor psychology becomes critically important, and why most individual investors are about to make the exact wrong move at the exact wrong time. Human beings are pattern recognition machines, and the pattern that most people have learned over the past 15 years is simple. When uncertainty spikes, the market dips, you buy that dip, and then central banks come to the rescue and push everything higher. This playbook has worked so consistently that it's become reflexive, almost instinctual. But this situation is different in a fundamental way. Central banks can print money. They can manipulate interest rates. They can buy assets. What they cannot do is print neodymium. They cannot create rare earth deposits through monetary policy. They cannot resolve geopolitical fragmentation by adjusting the discount rate. This is a real economy constraint, a physical world limitation, and those constraints don't respond to the tools that worked in a purely financial crisis. What we're likely to see, and what's already beginning to emerge in trading patterns, is a massive divergence between winners and losers that persists far longer than typical market corrections. The companies with locked-in resource access, with diversified supply chains, with pricing power that allows them to pass costs downstream, those companies will outperform dramatically. The companies that are resource-dependent, margin-compressed, operating in commoditized industries where they can't raise prices without losing market share, those companies will underperform dramatically, and the gap between these two groups will widen over quarters and years, not days and weeks. This isn't a dip to buy uniformly across the market. This is a regime change that requires genuine discrimination, actual analysis, real understanding of which businesses have durable competitive advantages in a world where resource security matters. The geopolitical dimension of this cannot be overstated, and this is where things get genuinely unsettling for anyone paying attention. Greenland is nominally part of the Kingdom of Denmark, but it has substantial autonomy, and its population of fewer than 60,000 people sits atop resources that could reshape global power balances. Multiple nations have expressed interest, some publicly, some through back channels. in securing long-term resource agreements, in building infrastructure, in establishing strategic presence. When you have great powers competing for access to critical materials on an island that's geographically remote but strategically vital, history suggests this doesn't end with polite negotiations and market-based solutions. History suggests this ends with spheres of influence, with security guarantees, with military installations justified as protective measures, with proxy competitions that spill over into other domains. And here's the truly sobering part. Markets hate uncertainty, but they hate unpredictability even more. As long as investors could model outcomes, as long as they could assign probabilities to different scenarios, they could price assets accordingly. But when you introduce genuine geopolitical wildcards, when the rules of engagement themselves become unclear, when it's no longer obvious which framework governs international relations and resource allocation, that's when capital becomes genuinely scared. That's when risk premiums expand. That's when correlations that used to provide diversification break down because everything starts moving together in a general risk-off stampede. We haven't reached that point yet, but the fragility is building. You can see it in derivative markets, in the skew of options pricing, in the demand for tail risk hedges, in the subtle repositioning of pension funds and sovereign wealth funds that manage money with decade-long time horizons. Smart money behavior over the past week has been methodical and revealing. There's been aggressive accumulation in specific mining companies, not the large diversified miners that everyone knows, but smaller specialized producers with actual rare earth exposure and credible development pipelines. There's been rotation out of high multiple technology stocks that are heavily dependent on stable input costs and into companies with vertical integration or long-term supply contracts. There's been buying of inflation-protected securities, of commodities, of real assets that perform well when financial assets are being repriced. There's been geographic diversification, reducing exposure to single-country risk in favor of globally distributed portfolios. And perhaps most tellingly, there's been a surge in volatility selling at higher strikes, suggesting that institutional traders believe we're entering a sustained period of elevated uncertainty rather than a brief spike that quickly normalizes. What does this mean for you, for the person watching this right now who's trying to figure out whether to sell everything, whether to go to cash, whether to buy the dip, whether to ignore all of this as just more noise that will pass in 2 weeks? Here's the honest answer. This situation has created both significant risks and extraordinary opportunities, and which one dominates your experience depends entirely on how you're positioned and how you respond over the next 3 to 6 months. If you're heavily concentrated in a few large technology stocks, if your portfolio hasn't been reviewed for supply chain vulnerabilities, if you're operating with the assumptions that worked in 2022 and 2023, you're exposed in ways you probably don't fully appreciate. But if you're willing to think critically, to look at sectors that have been ignored, to consider companies that solve the problems this tariff creates rather than companies that suffer from the problems it creates, the opportunity set is genuinely compelling. Energy security is becoming a megatrend that will persist for years. Countries that lack domestic energy resources are going to spend staggering sums on nuclear buildouts, on renewable infrastructure that requires massive amounts of copper and rare earths, on strategic petroleum reserves, on everything that reduces their vulnerability to external supply disruption. The companies that facilitate this energy independence, that provide the technologies, the materials, the engineering services, those companies are entering a multi-year growth cycle that the market is only beginning to price in. Defense and national security spending is about to accelerate across developed nations in ways that seemed politically impossible just 24 months ago. When resource security becomes a matter of national survival rather than economic optimization, budgets expand, procurement timelines accelerate, and defense contractors experience the kind of sustained tailwinds that create generational wealth for early investors. Infrastructure, both physical and digital, needs to be rebuilt with resilience, rather than just efficiency as the primary design criterion. This means redundancy, this means domestic production, this means supply chain visibility and control. The companies that provide these solutions, from advanced manufacturing to logistics technology to industrial automation that reduces dependency on imported materials, these companies are transitioning from nice to have to must have from the perspective of corporate and government buyers. And when something transitions from optional to essential, pricing power follows, margins expand, and multiples re-rate higher. The Greenland Tariff is a catalyst, but it's a catalyst for trends that were already building beneath the surface, trends toward deglobalization, toward resource nationalism, toward security prioritization over cost minimization. What happened this week didn't create these trends, but it dramatically accelerated them, it made them undeniable, it forced even the most complacent market participants to acknowledge that the world is changing in fundamental ways. And in periods of fundamental change, the gap between those who see what's coming and position accordingly And those who cling to outdated frameworks and hope for a return to normal, that gap becomes a wealth chasm that defines financial outcomes for years. And so let me leave you with this final thought, the insight that I hope you'll carry forward, not just for this specific situation, but for every inflection point you encounter in markets going forward. The most dangerous phrase in investing is, "this time is different," except when it actually is different. Most of the time, patterns repeat, cycles continue, and the investors who bet on reversion to the mean outperform those chasing narratives about paradigm shifts. But occasionally, genuinely occasionally, the underlying structure changes. The rules that governed the previous era stop working. And in those rare moments, the investors who adapt quickly thrive, while those who keep applying old playbooks get destroyed. The Greenland Tariff, combined with everything else happening in geopolitics, in monetary policy, in technological transformation, in resource scarcity, this feels like one of those genuine inflection points. Not a crisis that will pass in 6 months, but a shift that will define the investing landscape for the next decade. You don't have to sell everything, but you do have to think differently. You have to stress test your assumptions. You have to ask whether the companies you own, the sectors you're exposed to, the strategies you're employing, whether they're built for the world that's emerging or the world that's disappearing. And if you're honest with that assessment, if you're rigorous and intellectually humble, you'll probably find that some adjustments are warranted, that some opportunities deserve attention, that some risks need to be managed more actively than you've been managing them. If this analysis helped you see the Greenland situation differently, if it connected dots you hadn't connected before, if it gave you a framework for thinking about what comes next, do me a favor. Smash that like button, subscribe to this channel so you don't miss future deep dives into the market events that actually matter, and drop a comment below telling me whether you think this tariff is a temporary disruption or the beginning of a genuine paradigm shift. I read every comment, and your insights help shape future content. The game is changing, ladies and gentlemen. The question is whether you're changing with it.